say their A round to their B round, what's determined for those milestones or things that need to be hit for them to increase that needed valuation for that next round?
Well, there's a formula that is used in valuation, income divided by risk. It's one of the oldest methods that exists. It's the capitalization of earnings method. But that method itself drives value. I mean, how you increase value in general is either you increase your ability to generate income or you decrease your risk. In startups that don't have income, they only have one, and that's risk. So they have to demonstrate that risk is falling from round to round in order to justify an increasing value. If you don't have the financial metrics as to drive your valuation, you have to have that risk profile. So that income divided by risk is sort of something for an entrepreneur to keep in their mind, because if they don't have the income, they need to hedge risk somehow to justify increasing values.
And then how is that information presented to an investor?
That's a good question. I mean, valuation is not an exact science, and so it's kind of a negotiation. So a lot of times we will advise, once we work with the company on determining their valuation for funding purposes, we will work with them on how to present it. So you kind of want to present the key drivers. What is your peer group? Are you in a 1x revenue business or a 10x revenue business? So you want to present the drivers. You present your projections, you present kind of your stage. Where am I at? Am I a concept company? Do I have a product yet? Am I alpha, beta? Am I generating early revenue? So you have to be very, very clear in your stages for that.
What type of information does a startup need to present to you for you to assess where they're at?
A lot of it is an understanding of where they're at. What is their stage? Again, are they concept mode? Are they in alpha, beta? Are they generating revenue? Are they getting close to being cash flow positive? So financial information is first and foremost. I need to know where they're at stage-wise, and the financials typically will tell me where they're at on a stage-wise. Second would be their potential. Where do they expect to grow, and what's their growth rates, and what kind of market penetration are they going to have? And then third would be, we need to understand the industry they're playing in so that we can properly assess the peer groups. And when I mentioned peer group, I mentioned that word earlier. It's publicly traded businesses that are in their relative space. And the reason you need publicly traded businesses is because you know what their valuations are. You know what their revenue multiple or their earnings multiples are. It's either 5x revenue or 2x revenue, whatever that is. So you need to kind of know what industry you're in. So having an understanding of their peers is important. One of the things we can help companies is helping them find their peers. That's one of the things that we do for a lot of companies. Some startups, they might have some financial metrics and projections built, but they don't know who their peer is. And that's something we will help them kind of build their peer. But that's critical in determining the funding valuation.